Good evening, everyone, and welcome to Admiral Markets webinar of 16th of July 2014. My name is Nenad. I will show you how to trade non-volatility or low volatility trading. So as you remember, we also had high volatility trading. I hope that you found that kind of training useful. And today we will see if you want to trade on non-volatility or low volatility, still there is a way you can take a few pips out of the market. So I will show you how to do it if you're just impatient, or you like to trade new styles, you cannot wait for the trade to happen. I will show you how to grab at least few pips out of the market when there is no movement or there is very low movement. So before I begin, as always, our risk disclaimer. Risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author. It's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only, and this webinar is for informational, educational purposes only. So, with having said that, I will show you just a little bit of reminder how we did that last high volatility trade. If you remember, you probably watched the webinar just before it was FOMC minutes, or it was I think it was something about FOMC minutes or Fed minutes, something like that. It was just when we had the webinar, and this was how we traded basically high volatility. And if you remember, I made my stop loss something around there on demo platform, and I think I have it here in the history. This is all demo trading, just for showcase purposes. So yeah, it was well, I cannot find it now. Let's see if I am able to find it. It was, yeah, this was it. Euro, dollar. So stop loss should have been just below this point. So if you like to trade meeting minutes or FOMC, you always need to have a lower stop loss than it's compared to standard high volatility trading. So you see, price was hit. We took two entries there and there, and price hit our target, but unfortunately stop loss was indeed too small. So now we know what to do if we have a FOMC or meeting minutes or Fed statement, or if Mr. President of Federal Bank speaks, that is Yellen. So if she speaks, then you just need to have a stop a little bit lower. So basically this was it. Yeah, this was the volatility candle, then bang to the downside and up again. So that was about high volatility trading. You remember webinar. If you're not sure about the webinar, then just go ahead and take a look. I think that the webinar has been uploaded. So try to grab something out of it. Occasionally I do those trades. I had some of those trades also in the analysis. I'm waiting for New Zealand yen now. This is not low volatility or high, but this is what I'm waiting for. And I also can show you, basically I will show you now. Let me find it for you. A great trades, which we had great trades for GBPN. If you took this setup on high volatility, basically we had how it was today. The price hit 174 and you could have made 40 pips because it was rejected of this level. It was rejected of this level and you could have made some pips. So I told you, and you can see in the analysis 174.00. It was hit today, and this analysis was done yesterday. So it was hit today and the price jumped 40 pips before it started to retrace. So you could have made also 30 pips out of it. Let's see other things. Euro dollar. Euro dollar has almost hit the target zone. You remember this setup, and many different analysts and traders prognose that euro dollar will go up. Well, I saw it will go down, and it indeed went down. Now probably most of you guys now I see the question. Murtaz Nazam is saying it was not triggered due to spread. The thing is, guys, if you want to buy, you need to add the spread. If the spread is 2 pips and if 174.00 is the zone, you should put it at 174.02, because when you are buying, those are the basics of trading. I just cannot, I have mentioned that many times before. If you are buying the currency pair, you need to add the spread to your pending order. Okay? So if it's 174.00, if you have, I don't know, 2-3 pip spread, you need to add the spread to pending order. Always, because you are buying. If you're selling, you don't add the spread. You only add spread when you are buying. And please remember that those are very basics. Also, when I say the zone, it's not always to the pip. At least it's 174.00. So I have 2-3 pip spread on GBPN. So I made my order 174.03. But even if it wasn't hit, I would have bought it by market order at 174.05. Always add some breathing room. That is why it's called zone. It's not the exact price. I also I'm teaching you how to do it. So if you're risking 0.3 maximum, you can add at 0.1, 0.1, and 0.1 if the price is retracing. So if you use this analysis, 30 pips, if you did how I suggested you to do on euro dollar, you could have made more than 100 pips today. So it's pretty clear, it's pretty obvious. I always do my analysis before it happens because I want you to make money. Okay? These are all things which I trade also. So basically, if I spot a setup, I will trade it. Okay? So again, about volatility, what you need to know is, I will just give you a quick reminder. What is volatility, what is non-volatility, some advantages and disadvantages, and then I will show you the strategy, which is very simple if you want to trade on non-volatility. This is important. Successful trading, I am always showing you this slide, and I want you to remember this slide even if you sleep and when you sleep. So you need to dream about this slide, because if you take it seriously, how I took it, you're making the very first step to be profitable trader. And you're not a profitable trader if you have only 1 or 2, 3 months. If you're successful, at least 6 months of profitability, and with a very small and low drawdown, that will make you a profitable trader. If you lose 30% and then you make revenge trades just to go to break even, you're not a profitable trader. I just don't like to see those accounts which are built very fast in a very fast time, because that means the traders were over trading and used a bit more leverage than that is allowed. Of course, leverage is helping us to make the money. But using one full lot on $1,000 account, it's nonsense. Because if you put stop loss of 30 pips, and if you lose, you will lose 3% in a single trade. Even if you have a stop loss of 15 pips, you would lose 1.5% in a single trade. That is, for me, that's not acceptable. So, successful trading is always based on profitable trading strategy, risk management, and trading psychology. If one of those legs fall, everything will fall apart. That is for sure. Okay? And to the profitability, we can also add the element of volatility. So usually, if we want to be profitable, we need to see market moving. If we see that market doesn't move, then we are maybe it's a good way to stop trading for that particular day. If you're very impatient and you want to take a few pips, there is a way to grab few pips. I personally, you know that I trade 24 pairs. So if I see that volatility is low, I would usually wait for volatility to kick in. Yesterday we had GBP news. GBP news moved all GBP crosses. So you had a lot of opportunities to trade GBP dollar, GBP yen, GBP CAD, GBP New Zealand dollar, GBP Swissy, GBP Audi. Day before yesterday, we had, or 2 days before yesterday, we had CAD news. So Euro CAD, Aussie CAD, Dollar CAD, CAD Swissy, CAD yen. So always take into account which pair should be traded and when. If you see that the market is really strong in CAD, then trade CAD pairs. If you see that market is strong in dollar crosses, trade dollar crosses. Why would you trade euro dollar if there is no movement when you can trade CAD Swissie, for example, or maybe GBP yen or GBP New Zealand dollar? So if you're still unsure what to do, then this is the system for you, which I will show you. So you can basically trade on low volatility. Okay? As I say, I don't personally trade when there is no volatility. I always look for main movers of the market. Yesterday was GBP, 2 days ago was CAD, tomorrow maybe it will dollar. So there is always a main mover of the market. If you're unsure, then this is the thing you should practice. Try to make some pips on low volatility, at least until you're sure that you can trade 20 different pairs. What is volatility? Volatility, one definition says, is the amount of uncertainty or risk involved with the size of changes in a currency exchange rate. I would say that is how much a price fluctuates over a period of time. That is the simplest explanation of volatility. Indeed, that is how much a price fluctuates over a period of time. Volatility can also be a fast change of price during short time. And you know what it is. When price is heading in a single direction very fast, we say that there is a big volatility. If price is making sideways movement, then we say volatility is low. And the thing is, that volatility is usually magnified by the use of leverage. The leverage makes our money our money is making the money with the use of leverage. And volatility is magnified by the use of that same leverage. So more the leverage the traders use, the more volatile the market will be. Currency trading it always brings a high degree of volatility, because if the prices usually slept during one day or 2 days, that will mean that we can expect a breakout, and usually the breakout will be strong. And that is because currency markets, they do not have real volumes. They are not centralized. They don't have central exchange such as stock markets. The only measure of volume in forex trading is tick volume. Okay? Not a volume in its sense like it's in a stock market. So currency trading indeed brings a high degree of volatility. So even if the price is sleeping, you can expect it to break out soon on each of those pairs. Minor crosses usually give a high degree of volatility. GBP SVC, CAD SVC, GBP ODI, ODI CAD, Euro ODI, all of those pairs are moving and have been moving much more than Euro Dollar, than cable, than major pairs. And that is what I like when I trade, really. When I'm in a good side of market, instead of making 15 pips on a correlated pairs, let's say Euro Dollar is positively correlated to Euro ODI. So if I spot a good setup on Euro ODI, maybe there will be also a good setup on Euro Dollar. Then Euro Dollar would move for 15 pips. In the same time, Euro ODI would move for 35 pips. So if I don't want to be double exposed to Euro currency, I will trade only Euro ODI, because it will give me that kind of volatility to make, instead of 15 pips, I could make 35 pips. And my stop loss is always the same. It's in between 30 and 35 pips. Sometimes, on very rare occasions, it can be bigger. But it doesn't matter how big your stop loss is. The ultimate thing is risk. So my risk is always the same, 0.5 in a single trade. It doesn't matter if my stop loss is 30 or 32 pips. Usually it's 30 pips. But sometimes if it's a bigger stop loss, again, I would use a lower lot size for 0.5 risk. So if I'm risking 2% in a day, that means that I can go 4 different trades without a winner trade. And that is hardly to happen, really. So that is why you should also concentrate on trading those minors, so-called. Don't be afraid. There is always demo platform. So make use of that demo platform. Try to trade both on volatility and on low volatility. If you are not sure what to do, I repeat again, I don't usually trade on low volatility. Those are rare times when I scalp. But if you cannot trade, I don't know, if you are not sure what to trade, and you are afraid of that big, huge volatility, which can really make whipsaw on charts, then please try low volatility trading. I will show you how to do. What causes volatility? Every day is high impact news. We know which are high impact news, and usually they will trade they will cause volatility to the market. This is what I've been showing you. Yesterday we had GBP CPI, and you saw the movement of GBP pairs. All of them were great. Look at GBPN, GBP New Zealand. Look at this, guys. GBP New Zealand. So GBP New Zealand moved for 350 pips after the news from yesterday, while GBP dollar moved only 130. It's 3 times lesser than GBP New Zealand. I like it, really. I like those kind of movements. I had GBPN trade. Let me show you. Yeah, GBPN trade. GBPN also, yeah, it made a nice movement. But it also retraced. Low was 173.99. 41 pips after the analysis. So always pay attention. Yesterday it was GBP. 3 days ago it was CAD. Tomorrow, let's see tomorrow, Thursday, dollar pairs, also CAD pairs on Friday. Today, CAD pairs also. Let's see dollar CAD, what dollar CAD did. Look at the movement of dollar CAD. It gave some momentum to the market. So always pay attention to the thing. Everyday high impact news. Those will tell you which are the main movers of the market. And the main movers of the market, you can easily identify. If you see the GBP dollar is moving a lot, GBP New Zealand dollar is moving a lot, GBP yen, I don't know, this is the template for my strategy, GBP dollar, GBP yen, every kind of those pairs is, you see, it's moving a lot. So what would you do? You would trade GBP crosses for that particular day. GBP crosses. If you see that euro dollar is making price like this, okay, if you can try low volatility trading. Try to grab some pips, but don't expect, I don't know, dozens of pips when price is not moving. So that is, you can try to make money on low volatility. But generally speaking, high volatility is better. Normal volatility is the best. Okay? Also, I cannot say that very big volatility can be excellent. Usually it's good. But that means that sometimes the price will make bullish candle. But on the next candle, it can kill your stop loss, then move in the original direction again. So the thing is, low volatility is the lowest of all of those volatility thingies. High volatility is good if you know how to exploit it. But normal volatility is the best. So if the price is making higher high, then it is making a higher low. You know that basically the price is trending. Then you can, on normal volatility, you can easily place a trade, which will usually go in a profit. That is the scholastic example of trading. But sometimes the price may move like this. Sometimes the price may move like this. So in both ways, you need to know what to trade. You cannot trade high volatility method, which I showed you, if there is normal volatility. You cannot trade low volatility method if you see a high volatility. And that is what many traders just do not know. Even some professional traders, they have their own systems how to trade, but they are completely neglecting the importance of identifying normal, low, and high volatility. And then they get in a problem when market is ranging and they want to go with trend trades. Usually it will kill their accounts, especially if they are swing traders, because swing trading is the ultimate nemesis of volatility. Rumors also cause big volatility to the market. Usually when we have some unconfirmed rumors, then what can we say? We can say buy the rumor, sell the fact. So basically market may move in irrational way if there is an important person who gave, some prognosis for a currency pair or exchange rate or minimum bid rate or whatever, which is unconfirmed. Then we say it's a rumor, and usually after the rumor the price will go violently. You know how it looks. Usually it looks like this. The price is making nice trending movements, and then all of a sudden, out of the blue, the price is making, wow, big drop or big jump, it doesn't matter, and then gradually comes in its original way. And at this moment there was no news which could have been a catalyst for this move. In that way we usually say it was a rumor which made a stop loss hunt, but then it reversed in its original direction. That is usually when we say there is a rumor incoming. Geopolitical events. We had Ukraine crisis. It was also a mover of ruble, and you saw the initial reaction of dollar ruble pair that basically it dropped a lot. Now Yves is asking, it is not a question of banks correcting the price but a rumor. Yeah, sometimes Yves, banks indeed can correct the price, but look at this. If the price is making higher highs and lower lows, then let's find a better example. I will switch to euro dollar daily chart. No, sorry, monthly chart. And I will, this looks to, let me find, this is good example. Okay, daily chart. I will use a blank template, and let's see, guys. Okay, this is the example. You remember this time. Now I'm answering Yves' question. That is not a question of banks correcting price but a rumor. How can you identify, or how you can identify when price is really corrected by the banks, not by rumors? Look at this. This is monthly chart. This is euro dollar. This was the top of euro dollar. It was the year of 1st of July 2008, and the price was 60.36. Okay, so 60.36 was euro versus dollar. Okay, and then what happened? You know, and you know what USA crisis was, and euro was really going lower, and then it made a new lower high, but then it made a lower low. What happened is, at this point, banks had already been in agreement that they will correct the price. So the lowest low was this. In the year of 1st of June 2010. And this is better example because this was the lowest low after the jump. So the lowest low was 1.1875. At this point, this was a central bank intervention. During next month, the price, you saw how much it almost went 1,000 pips on a pair which normally makes, I don't know, 60, 70 to 90 pips average. So this was a clear central bank intervention. So this month was central bank, one day was enough for central bank intervention. And you know the statements, they will correct the price. After that, short covering happened. And after that, again, the price made its normal range movements. So when the price is pushed to the extremes, when you see that the price is really pushed to the extremes, then you can expect central bank intervening to lower the price. If it is too high, too strong currency is also not very good because it can cause deflation. If currency is weak, it will cause inflation. So central banks are usually intervening to stop either inflation or deflation, which is very possible on extreme high or low prices. So banks can correct the price. But usually, if you see the price moving normally, and then all of a sudden, without any prior announcement or news, you see a huge drop, but then instantly, during the same hour or during the next few hours, the price corrects itself. So this is not banks intervening. This is usually a rumor. When central banks didn't intervene, they can make the price go up, down, or up 500 pips in a single hour, guys. And that is how you can identify easily whether it is some sort of a rumor or something, or it's a central bank intervention. Usually there is some sort of rumor, and you can follow Forex Live. They're always updating those interesting stuff about telltales, rumors, and so on. So Forex Live, they will always tell you, yeah, that was a rumor, that was I don't know, option barrier or something like that. So if you're interested to know what happened, just visit Forex Live site. Yeah, sometimes also on Forex Street you can read about it. But they usually copy-paste it from Forex Live. So geopolitical events, macroeconomical news. So macroeconomical news which are important for the global economy, natural disasters. Remember what yen pairs did a couple of years ago when there was an earthquake. Many people have lost their accounts, and I personally witnessed that some of great traders lost a lot of money during the earthquake. If I remember correctly, yen was gaining strength, and they were trying to basically short the yen. So there was huge movement on yen pairs after the earthquake in Japan. Central bank interventions, already talk about it, and profit taking. Friday is profit taking day. Usually you can see price trending in a single week, then on Friday you can see a correction. That is called profit taking. This is not, I will show you now what profit taking is on a real chart. Remember dollar yen. Dollar yen, let's see, dollar yen. This was basically at this point it was NFP. This was NFP. And what happened is NFP pushed the price to the extremes, and I really expected it would go up, but unfortunately profit taking dropped the price to this point, and now it's correcting again. So profit taking can make a lot of unnatural movements in the market. But that is also the way how market works. We need to take all of these things very seriously when we are making trades. So there are always things to watch for when you're trading. So, advantages of volatility. In order to make money, we should have volatility. We can trade on low volatility. I will show you how, but you should decide whether you want to do it or not. Volatility will give boost to our entry, turning it into a profit soon. It can give us fast scalping trades. It can give us also scalp swing. Thanks to good volatility, last month I made almost 7%. And my goal is usually in between 2 and 5% per month. And last month, it was June, almost 7% thanks to nice volatility. Not huge, not low. It was okay. Intraday direct rise, direct fall. What is direct rise or direct fall? When price is making this kind of movement, it's called zigzag and it's trending pattern. When price is making this movement, it's called direct rise. When price is making this movement, that is called direct fall. All of those are examples of volatility. Momentum trades. If you take the advantage of volatility in your trading system, you can exploit some nice momentum trades. Triangle. Breakout. First trigger happy entry, you have momentum trade. Retest, okay. Continuation, you have momentum trade. Reverse position. You are long at this point, and this was very, very important support. And the price is indeed making it to the upside. But then all of a sudden, the price drops below this level, which wasn't broken for 1 month, let's say. And then you can easily kill your first trade and open a second trade on retest or trigger happy or continuation trade. But usually momentum will give you a trigger happy trade. Because the price, when it's volatile, it has good momentum. And you can make some 5 to 10 pips, even if you go bang. Important high was broken, BC volatility, yeah, I will. But those kind of trades usually require you to be very fast, and I personally don't like them. I like more retests and breakout pullbacks, continuations. Even those, it's very hard to make a proper continuation trade if there is no strong trend. But then we can go for retest trade. Retest is always good, and I am hoping for that retest trade also on basically it's not a pure retest trade, but there is a form of retest. I will show you. Camarilla MACD setup. New Zealand yen for today. This is breakout. So momentum kicked in here, because if we see in the short-term history, historical buyers turned sellers. So this was the history of buying all from this region. If you want to trade seriously, you always want to look on historical buyers and near-term sellers and buyers. You need to know the historical price action, near-term price action. So these were all historical buyers. And look at this, at this point, look at this candle. This is big momentum candle. Only by this candle you can say that it will go. I'm really sure that if the price gets here, I will sell the price. Because first I saw historical buying, then this level was broken. And look, it was not broken by small candle. This candle is big. So it indicates momentum. It indicates that fresh sellers will show up here. So breakout, pullback, retest possible, POC, 50% of retracement L3 level, historical buyers, and bang, we should go to the downside. Even though if the price makes 30 pips, again, it's a retest possible trade, and it should be good. So that is basically when I say breakout trading. Okay. Now I will say about disadvantages of volatility, and then I will show you the system. Disadvantages of volatility. Probably you know that overtrading and revenge trading are the biggest nemesis of your account. So if you see a big volatility, there is a chance that you will try to overtrade it. Trade more than that is enough. If you lose one position, you would probably add double almost instantly after you lost the position, just because you want to revenge trade and you see that price is moving. That is a stupid thing to do. Gambling is not trading. It's completely different. So we traders are not gamblers. Swing traders suffer from huge volatility. Yeah, I know, and I will show you how. GBP dollar. What we saw is that the price, and many traders saw the price going from this point to this point. And I know that many traders got into position somewhere around there, waiting for a full swing to happen before they make another long trade. What happened is all of those positions have been liquidated at this point. That is, we see stop triggering, and then the price dropped again. Look at this level. How important you find this level. We can say this is the level. Every single time the price was rejected below the 71.70. Try to go up, nothing. Tries to go up, nothing. Tries to go up, nothing. Tries here, nothing. Yeah, maybe they were right about their short positions. But now look at this. Probably their stops, because they are usually trailing the stop, their stops have been triggered. That is why I'm saying swing trading is very unsustainable in these market conditions, unless you're trading without a stop loss, which is totally most stupid thing you could ever do to yourself. Trading without a stop loss. You are not a trader if you trade without a stop loss. Whipsaws on every time frame. Whipsaws. Non-tradable environment on huge volatility. When we have whipsaws, we don't trade. And traders who don't trade 20 pairs may suffer a lot. And now that is why we are talking just if you don't trade 20 plus pairs, you want to trade only 1 or 2 pairs, and you see that there is no big movement of the market, you can try this kind of trading. Low volatility trading is achievable. So if you want to trade low volatility, forget about trend trading systems. As I said, many traders, real traders, they just I don't know, they put their setups all over the internet saying the price will go there, will go there. I'm not bothered to read those kind of things. I respect every other trader, and I really respect every other analyst. But guys, use common sense. If the price is going sideways and you see that there are there will not be any main movers of the market that particular day, do you really expect that the price will break out of and make a new trend? And we know that, let's say, banks are on holidays, USA is on holiday, Europe is on holiday. So what does it leave? It leaves only retail traders and market makers. And yet again, I see many analysts tend to analyze the market when there is no volatility. I think that is also a very stupid thing, because you can analyze the market only if you see the movement, if you see that price is making movement. If it's low volatility, we can try to analyze how I do it by levels. I usually say if the price breaks above this level, we can expect that level. If price breaks this level, we can expect that level. And yet again, I'm not talking about volatility after the price breaks this or this level. I'm talking about stops which will be triggered when price is breaking this or this level. And that is the only way we can analyze what can happen if there is no volatility. Because we are counting on stop triggering, stop hunt. There is not a real volatility. It causes volatility. But there is volatility which will last until all the stops have been collected. What is the question? Maria is asking me, what is the lower time frames? Please, Maria, I don't understand your question. What's the lower time frames? I will show you the method now, system, and I will tell you which time frame if you're referring to system. The time visible on MT4, the lowest time frame is 1 minute by default on MT4. This is the lowest time frame visible. M1, yes. You can change that also with some scripts and so on, but I don't recommend, because I don't trade on 1 minute time frame. So that is the lowest time frame by default on MT4. So you're welcome, Maria. Stay away from majors. Try to trade minors. If you see that there is, I don't know, dollar, bank holiday, do not bother with analysis. Try this system, strategy which I will tell you, and try to go with minors, because they will give you those extra few pips over the majors. And always pay attention that you pick up minors with lower spreads. Forget about adding into retracements. Forget about everything you know about trend trading. Forget about candlesticks. Forget about POCs. Forget about the stochastics. Just forget about it. Low volatility trading is completely different. Reduce targets. Targets should be accordingly reduced to reflect the market movement. And chance for pending orders is reduced. Forget about pending orders. Okay? So how to trade it? Now, I will give you a couple of minutes to memorize this slide. So strategy for low volatility. You should open bar chart. Bar chart is this. This is candlestick, and this is bar chart. So open bar chart, okay? We need to see if market is in congestion phase. You should buy low and sell high. That is the only thing you should think about. Buy low, sell high for low volatility. Congestion phase, when price is low, that means that price is making 3 consecutive down closes or so-called lower lows. When price is high, 3 consecutive up closes or 3 higher highs. Rules. Time frame usually 15 minutes and above. On low volatility, I suggest you should use 15 minutes. ADX should be below 25 and less than it was 3 bars ago. So you should add ADX 14 to the chart. Okay? So this is very important rule for both longs and shorts. ADX should be below 25 and less than it was 3 bars ago. That is the ultimate rule. For long positions, 3 consecutive lower lows and buy on third lower low. Short positions, ADX below 25 and less than 3 bars ago, and then 3 consecutive higher highs, sell on the third higher high. This is how it looks like. Low volatility, we see that there is no big, you see how price is making those sideways movement. At this point, ADX was below 25, going lower and lower, and you can see 1, 2, 3 consecutive lower lows. Lower low, this is, okay, this is high, this is the first low, this is the second low, and this is the third low. After that, you buy, and you see you could have made some 10 pips. Same here, 1, 2, 3. Look at this. You want to sell. You see that ADX is going lower. It's lower than 3 previous bars. Okay. This is the ultimate rule, don't forget. 1, 2, 3 higher highs. Then on this candle, you sell. Again, some small profit. 1, 2, 3. Again, down. You see, this kind of method will give you a few pips here and there. But that is the way how you can try to trade on low volatility. But this is strictly mechanical, and those rules should be respected. Okay? So, exit is on the third bar close after the entry. As I said, forget about pivot points, forget about everything you know about trend, counter trend trading, breakouts, scalp methods. Exit is on the third bar close. So at this point, 1, 2, 3, we would have exited here. We would have exit here. 1, 2, 3, 1, 2, 3. This is our exit. 1, 2, 3, 1, 2, 3. This is our exit. All of those trades are profitable. Not much, but they gave you a quick glance how you can trade on low volatility. Stop loss is placed through 3 to 4 pips above below last week high low, and stop should not be more than 12 pips on 15-minute time frame. If you see that your stop is above 12 pips, you just don't trade. You should not trade. Low volatility is usually 1 p.m. GMT, 6 p.m. to 11 p.m. GMT. Bank holidays, when market is waiting for important news, pre-NFP, and you need to know that session volatility is not the same for each pair. Euro-dollar won't move much in Asia session, but New Zealand dollar, ODN, GBP New Zealand, so New Zealand and OD pairs and yen pairs will move on Asia session. So try to spot by using ADX which pairs are low volatile and trade it. Trading a low volatility is not for everyone. So you can either like it or don't like it or not. So try it. You can either make money with this or not, because it's pretty mechanical. You need to watch ADX, 3 consecutive closes, 3 consecutive closes. Stop loss not more than 12 pips. Always demo trade before you go live. Always use adequate money management. Base your volume traded on your stop loss, not on your possible TP. Never ever overtrade. Never ever make any revenge trade. And remember the tripod of successful trading. So guys, this is what I was intending to show you. If you have any questions now, do not hesitate to ask me. I will gladly answer. In the meantime, watch for premium webinars. Sign in for MTF MACD indicator. I will be giving a system which uses scalping on 1 hour time frame by using multiple MACDs and the MACD arrow indicator. So you will be given 2 indicators. The first is multiple time frame MACD. You can, if you like MACD, you can use this because it's MACD 2-line, but it works on multiple time frames. It shows you higher time frames on lower time frame charts. It's very useful. And for premium members, I will show you how to scalp on 1 hour candles by using MTF MACD indicator and 1 indicator more, which is complementing to MTF MACD, MTF MACD. Sign in for many good webinars, of course, for free pips for weekly Forex recap, as this week was also great, especially GBP dollar, which made more than 120 pips. So I will show everything, of course, on next recap and use this. So I don't see any new questions, so assuming that you don't make any questions in the next half a minute, I will call it a day. Everything Yves is saying all clear, thank you. And again, watch for new analysis each day, every day, for new setups on Admiral Markets blog and on Forex Factory. And I hope you will be making money. So thank you guys for your cooperation. Thank you for listening to me. And cheers everyone. Bye for now.